Good morning, and welcome to episode 134 of Getting Rich. I'm your host, Rich Checkan, president of Asset Strategies International, and today is Wednesday, August 3rd, 2023. Well, last week, as fully anticipated, the Federal Reserve increased interest rates another 25 basis points. As a result, the markets for the past week have kind of traded in range, whether it be metals or equities. And the reason for that is very simple. Even though everybody on the planet expects that the Fed is either done or very nearly done raising interest rates, what market participants really want to see is a pause followed by a pivot. And the stable labor market and cooling inflation numbers suggest that that's not going to happen anytime soon, and certainly not by the end of this year. So one point I want to raise, though, is even though inflation is cooling, the numbers aren't rising as quickly as they were earlier this year. You got to understand, we are still paying more for virtually everything than we did a year ago. It's just not increasing at the pace we saw earlier this year. With all this news going on in the background, and given the way Congress has mismanaged our currency for decades at this point, Fitch Ratings has downgraded United States of America's long-term foreign currency issuer default rating, the IDR, from to AA plus from AAA. Fitch went on to say that the repeated debt limit political standoffs and last-minute resolutions have eroded confidence in fiscal management. In addition, the government lacks a medium-term fiscal framework, unlike most peers, and has a complex budgeting process. These factors, along with several economic shocks, as well as tax cuts and new spending initiatives, have contributed to successive debt increases over the last decade. Additionally, there has been only limited progress in tackling medium-term challenges related to rising Social Security and Medicare costs due to an aging population, according to Fitch. It's about time somebody said it and did something about it. Let's take a look at the numbers, and then we'll get back to a little bit more on that in a second. Gold, over the past week, has fallen 0.9% to $1,953 an ounce from $1,969.90 last week. Silver is down 1% as well, to $24.49 from $24.73 last week. Platinum is down 3.4% to $938 an ounce from $971 an ounce last week. And palladium is down 3.3% to $1,271 an ounce from $1,314 an ounce last week. Silver lagged gold a little bit last week, so that gold-silver ratio is up. It now takes 80.03 ounces of silver to buy an ounce of gold versus 79.94 last week. And despite the downgrade by Fitch Ratings, the dollar is up to 102.24 this week from 101.14. And you know as well as I do that that's going to be short-lived. Despite the downgrade, again, the dollar is up. We have the Fed coming to the end of their rate hiking capability. They can't go much further from here. That coincides with the traditional switch from the summer doldrums in metals to the fall, where we tend to see increased spending. And all of that suggests that by the end of this year, we could very well see a liftoff in precious metals prices. My only question for you, the only questions I have for you right now are, got gold? Got silver? I think if you don't, you should be accumulating it right here and right now. As always, we'd like you to go ahead and follow us on YouTube. Like us, send us your comments and questions. Follow us on our social media for Asset Strategies, as well as our monthly newsletter and our twice weekly alerts. But don't ever forget that getting rich starts with keeping what's yours.